We're diving into like-kind exchanges. Super popular, super important topic for the exam. It's been historically on the exam quite a bit. It's also something that some people have struggled with, but we're going to make sure that you get through it in as best a way as possible. If you hear me say realized, recognized basis over and over, that's something, if you've heard that before, yeah, that's going to be very important here. We're going to deal with what is the gain or loss realized, what is recognized, and then what is the basis of the new asset acquired. Now, like-kind exchanges, the IRC/IRS allows for tax-deferred like-kind exchanges where a taxpayer can exchange one property for another similar property without recognizing, meaning without having to actually put a gain or loss on the tax return on the transaction. The rules for like-kind exchanges are set out in section 1031. You don't really have to know that. To qualify for like-kind exchange treatment, the properties being exchanged must be held for productive use in a trade or business or for investment purposes. They also must be of like kind, which means that they're similar in nature or character, even if they differ in quality or grade. If I'm trading an old truck for a new truck, that sounds good. If I'm giving land for land, that sounds good. If I'm giving a warehouse for an office building, yeah, it's building for building. And they're not going to really trip you up too much on that. They'll make it much more jarring, like giving a truck for a building, which that obviously that's not like kind there. We'll see the concept of boot as we go through this. Boot is loot. We'll see that. We're also going to understand how losses here, you're not going to be able to benefit from losses. However, the gains, you may have to recognize gains in some cases. But yes, this does have to be for use in business. I can't trade a car to my neighbor for his car, and neither of us are using it for business. It's just personal cars. This is dealing with business transactions. We've got some examples of like-kind exchanges here. Generally, these are what you'll see on the exam. Real estate for real estate. So let's say rental property can be exchanged for another rental property, or a farm can be exchanged for another farm. Personal property for personal property. Business equipment such as machinery, vehicles, or office furniture can be exchanged for similar items. The whole point of this, the IRS wants to facilitate transactions, get items into the hands of those who need them. If I have an ice cream truck and I want a delivery truck and someone else wants an ice cream truck, that's helping the American economy because now assets are getting into the hands of those who need them to then stimulate the American economy, make some revenues. The revenue gets taxed. You see where I'm going with all that. That's why the IRS allows this. It's important to note that like-kind exchanges are not entirely tax-free, as the tax liability is deferred. So that's what we mean by deferred. Your basis, that's super important. If I've got a selling price of $10,000, eventually I sell an asset, I want as high of a basis as possible because I pay tax on the difference between the selling price and the basis. So if I have this like-kind exchange and I'm not paying tax on any transaction now, it may reduce my basis from, let's say, $7 to $5. So now I'm paying tax on an extra $2 there. We see the difference. So that's deferring the tax. That's the concept of deferred tax, something that comes up a lot throughout the exam, and I'm always going to make examples here and make sure we understand what's going on here. So it's deferred until the new property is sold or disposed of in a taxable transaction. Obviously, if you keep doing like-kind exchanges, then you can theoretically go on and never have any tax recognition, but that's not really anything we'll see in the exam. Additionally, there are strict timing requirements for completing the exchange and certain rules for identifying replacement property. We'll see how you can't just kind of drag on this. You can't buy someone's truck and then wait. There will be day amounts, and we'll talk about those as well. Some more points about like-kind exchanges. The exchange of like-kind business, investment, real property. So like-kind exchanges, these allow taxpayers to defer the capital gains taxes when they exchange one business or investment real property for another of a similar kind. They must be real property, such as buildings and land, used for business or investment purposes. Drilling in that, this is the biggest, most important point to make sure you know that. It'll have to say that there, we can't just have a taxpayer exchanging their car for someone else's car. The deferred amount of gain or loss, it's equal to the amount realized minus the amount recognized. The amount realized is the value of the property received in the exchange, while the amount recognized is the actual taxable gain or loss. For timing, for a valid like-kind exchange, the replacement property must be identified within 45 days of giving up the original property. Additionally, the replacement property must be received by the earlier of 180 days after the transfer of the original property or the due date of the tax return for the year of the exchange, including extensions. Not as much of an important rule, but something to know. Recognized gains in a like-kind exchange are only recognized to the extent of the boot received, because we're talking about this and we're generally saying that they're non-taxable. So what's the point of mentioning recognized gains? Well, we're going to introduce this concept of boot. Now, what is boot? If I'm exchanging and this is an important concept. It's going to pop up in a few other lessons as well. If you know what it is, awesome. If not, we're going to go through it. It's essentially a kicker. Think of it like a boot trying to kick something. It's a kicker to make the transaction go through. If I'm exchanging a truck for a truck and the other party is saying, but I don't really want to do that. Maybe if I throw in an extra $10,000 in cash, or if I give them securities, as we see here, anything that is not part of the initial asset for asset. Also, debt relief. That's another item here. If I am giving up my truck, and let's say there's a loan on that truck that I haven't paid down, if I'm getting debt relief from that, that could also be boot. So boot is anything unrelated to the specific asset A for asset A, right? Trading apples for apples, oranges to oranges. I know you can't do any like kind of exchanges for fruit because those are not buildings and land. But so boot again it's kind of just that kicker. It's a concept I would definitely make sure you're familiar with. Again, it's any non-like-kind property received in the exchange. Generally, we'll see it as cash or debt relief. The recognized gain is the lesser of the gain realized or the boot received. If no boot is received, then no gain will be recognized. So step one for all these is going to be what's the gain realized? As I've said, realized, recognized basis. Step one is what is the realized gain? What really happened? What is the value you received versus the value you gave up? And then the recognized gain, what you're actually going to record on the tax return is the lesser of the boot received or the realized gain. So if you receive boot, or if no boot's received, then it's going to be zero. So the lesser of the gain realized or the boot received. If you realized $3,000 of gain because the value of your truck was $3,000 more than the truck you got, so that's $3,000 of realized gain. But if you didn't get any boot, then no gain is, and remember, it's boot received, not boot paid. Zero is less than $3,000, so no gain will be recognized. We'll have lots of examples of this. I know I usually have a lot more numerical examples by now, but we will be seeing plenty of those, as well as you got to practice these on your own for sure. Losses are not recognized in like-kind exchanges. Pretty straightforward there. Instead, they affect the basis of the new property received, which defers the loss until the property is sold in a taxable transaction. So we're going to generally add any deferred losses to the basis and subtract any deferred gains because that will reduce or increase our basis so that eventually we will get the benefit of those losses or gains. And then debts assumed and relieved. So if we're taking on someone else's mortgage, if we're doing a building for a building, we're taking on someone else's mortgage and maybe they're taking on the mortgage from our building. These are going to be netted together. The difference in the debts is considered boot, and whoever benefits more from this, they are going to likely recognize a gain. Here are some exchanges that are not considered like kind. Now, I mean, these kinds of questions are difficult enough as is, just doing them mathematically. But we also have to understand just what are some exchanges that are not considered like kind. So these 1031 exchanges, this is preferential tax treatment. However, not all property will qualify for like kind treatment. Here's a list that are not considered like kind. So personal property exchanged for business property. Again, if I've got my personal TV, a personal car for something else, that's not we're not dealing with that. No personal property. Only stuff used for business. Real property held for personal use. Again, personal use, nope, nothing like that. Immediately, don't pass go, don't collect $200. Real property located in the US for something outside, nope, this is only for United States property. So once something gets introduced that's outside the US, does not qualify. Inventory or stock trade-in, such as items held for sale in the ordinary course of business. No, you should be selling that as a normal sale. You shouldn't be doing any sort of like-kind exchanges there. Inventory or anything that like the ordinary course of business is I sell inventory. It's not that I sell trucks, right? McDonald's, they're not in the business of selling trucks. So if they sell a delivery truck, that would not be the ordinary course of business. And as such, that could be a possible like-kind exchange. Stocks, bonds, notes, or other securities or debt instruments. Yep, not like-kind for tax purposes. Now, we did see that before as an item, and that is in very limited circumstances. 9 times out of 10, yeah, we're just not going to see examples where you exchange stocks for stocks and bonds and all that stuff. Partnership interests or shares in a corporation, not allowed. Certificates of trust or beneficial interest. Certain types of intangible assets, such as goodwill, going concern value, customer-based intangibles, or workforce in place. It's kind of just lesser importance as we go down, just making sure we cross all of our T's and dot all of our I's. And then livestock of different sexes or species. As I've mentioned, just in various points throughout the exam, a lot of the tax law is built upon farming because we are a very agricultural society, even if you live in a big city and have never seen a farm, that is something that for sure our entire tax code is built around. That's why we've got schedules dedicated just to farming income. So that's, if you see anything like that, it's not just, oh, that's out of nowhere. No, we actually have a significant amount of tax code written around farming. Boot, boot, boot. Oh yeah, we're gonna make sure we understand what this is. Boot. I've heard it called loot. It is what you're getting in excess. You're getting this nice little kicker, this nice little extra benefit in addition to getting the truck or the property or whatever it is from the other person. So boot refers to cash or other property that's given to balance the value of the exchange during the transaction. It's commonly encountered in transactions such as mergers, acquisitions, or like kind exchanges, which typically involve the exchange of property rather than cash. The presence of boot can affect the tax treatment of the transaction, potentially resulting in taxable gains and losses. So if I'm giving a truck up that's worth $200,000 and I'm getting a truck in exchange worth $230,000, I may give an extra $30,000 because that person's like, hey, I'm getting screwed here. I'm not getting the value that I'm giving up. So that's, again, why we would likely see this. Here's an example of boot in a taxable like-kind exchange. Let's consider a scenario. We've got company A wants to acquire company B's assets in a taxable transaction. Company A offers $900,000 in cash and company A's property worth $100,000 in exchange for company B's assets worth $1 million. So what is going on here? The transaction would be structured as follows. Company A transfers $900,000 in cash and its property worth $100,000 to company B. And then company B transfers its assets worth $1 million to company A. And we see these balance out. And for like-kind exchange questions, a lot of times, yeah, we will see them balance out. I mean, it makes sense that the ultimate values of what's being transferred add up. In this taxable transaction, the boot would be the $900,000 paid by company A. Company B would recognize a taxable gain or loss based on the difference between the fair market value of the assets received, which is $900,000 in cash and $100,000 in property, and their adjusted tax basis. On the other hand, company A would also recognize a taxable gain or loss on the transfer of its property based on the difference between the fair market value of the property transferred and its adjusted basis. In this taxable transaction, the boot paid by company A affects the tax treatment for both parties involved. The gain or loss realized by company B on this transaction would be subject to taxation, whereas company A would need to recognize any gain or loss on the property it transferred based on the difference between the fair market value and its adjusted tax basis. Now, this question in particular, this is not really a like-kind exchange. This is referring more toward what we'd see sort of in an acquisition or a merger. Obviously, this is much more of an acquisition, but this is not anywhere near a sort of like-kind exchange. We're just talking about, in general, assets, property. So I would not identify this as a like-kind exchange, kind of like a trick question, but applying some of the same rules and seeing boot play its role in a question. Because what are we really doing here? I mean, the cash is the real kicker of this. This is the whole kahuna. This is everything. We're basically just buying this, and the property is the boot rather than property for property or assets for assets. So we see this is not really a like-kind exchange. This is just an example of where we'd see boot play a role. Like-kind exchanges, I would, oh my gosh, memorize these, please. I was referring to these a little bit before, but for the life of me, I need you to memorize these, otherwise I may just drop dead. So please do it. It's that critically important. So realized, recognized basis. This is super important, and I know we've got it in a little bit of a different order here. First, what is the gain or loss realized? I know basis is up there. I'm going to go here first. The gain or loss realized is calculated by comparing the amount realized, which is the value of the property received in the exchange, with the adjusted basis of the property given up. So amount realized minus adjusted property basis of property given up. If I got something worth $100,000 and I gave up something worth $80,000, I benefited $20,000, and that's great, awesome. So that would be our amount realized. That would be, and it could be a loss, but that's our, in this case, gain realized. Now the formula for basis in a like-kind exchange, when boot is received, the basis in the property is calculated as the following. Now the basis is going to be the fair market value of the property received, just like if you bought something. So if I go and buy a laptop at Best Buy for $5,000, that is the fair market value, but that now becomes my basis. However, what happens if we have deferred gains and losses here? You're going to subtract deferred gains and add deferred losses, because losses add to your basis. So eventually when you sell, then you'll have less tax because your basis is higher. Deferred gains are going to get subtracted here because when you eventually sell, that'll be a lesser basis, and as such, you'll pay you tax on the difference. This formula takes into account the fair market value of the property received, any deferred gain, and any deferred loss. This basis will be used to determine the gain or loss when the property is ultimately sold in a taxable transaction. Continuing on here. Like I said, please memorize all this stuff. It's super important. The formula for the gain or loss recognized, super important. In a like-kind exchange, the gain or loss recognized is limited to the boot received. The formula is the lesser of the realized gain or boot received. So again, in that prior example, if we had a $20,000 gain, that's great, but what's the lesser? If there was no boot received, boot's zero, so that's going to be zero. But if boot was greater than the realized gain, we'd recognize the boot as the gain recognized. Now, we're not recognizing losses here. Losses are never recognized in a like-kind exchange. Losses will affect the basis of new property received, specifically what we just saw in the prior slide, which defers the loss until the property is later sold in a taxable transaction. And then what is the formula for the gain or loss deferred? This is going to be the difference between realized and recognized, because what really happened minus what did you record on your tax return, that is deferred, which actually take that for a second and think about that. If that doesn't make sense, think about it more. What you realize, what really happened minus what you actually recorded on your tax return, that is being deferred. You're going to eventually, it's kind of like the concept of deferred tax assets and liabilities, if that's something you're familiar with. That's not as big on this exam, but we'll talk about that in later lessons in our difference between book and tax. But that's something we see here. So generally this you could say is book and this is tax. Deferred gains or losses will affect the basis of the new property and will be recognized when the property is eventually sold in a taxable transaction. In summary, to be taxed in a like-kind exchange, a gain must be both realized and recognized. I mean, primarily just recognized, but you're not going to recognize it unless it was realized. So that comes out in the wash. Here is a nice summary of what we've got here. Memorize these formulas. Please, please memorize these formulas. This is critically important for these types of questions. I know it's a little bit out of order, but this is generally the process. We go step 1, then we go step 2, then we go step 3, and then we go step 4. So this is the order to have it memorized. Definitely, please have that. Basis is just incredibly important, so I put it there first. But please, please memorize this. Super important. All right, now we get to see the magic happen. We're going to see this in the correct order as well. You own an investment property, property A, with an adjusted basis of $200,000. You participate in a like-kind exchange and receive another investment property worth $300,000 plus $50,000 cash, which is the boot. This is an iconic classic example, like not this exact one, but the way it's laid out, this is absolutely awesome. And just keep in mind, like I said, the process is realized, recognized, and then basis. This is like step 2.5. Calculating the deferred gain or loss. If the question asks you, based on this information, what's the basis of property B, you still have to go through all the steps. You have to first determine the realized, then the recognized, then the deferred, and then you get to the basis. So this process happens time and time again. So what is the gain or loss realized? And also this could be from the perspective of A or B. So we got to know all three of these, and then for all the perspectives from company A and company B. The amount realized is the fair market value of property B plus the cash received. So in this case, it's $350,000. You gave up $200,000. So what really happened? You really got $350,000 of value, and you had to give up $200,000 of value, giving you a realized gain of $150,000. So that's what really happened. However, what is the gain or loss recognized? What are you actually going to record on the, I was going to say financial statements, but on the tax return? And this is where the arbitrary IRS rules come into play. So the recognized gain, we know we have a rule here. It's going to be the lesser of the realized gain or the boot received. So nice simple math here. What's less? Is it 150 or is it 50? That is going to be 50, which is the cash, the boot. And as mentioned earlier, losses are never going to be recognized in a like-kind exchange. So just keep that in mind. Now, what's our deferred gain? Just memorize these formulas and you'll be good to go. That's your realized gain minus your recognized gain, because recognized is what you're paying now. So that's what you're deferring. You're deferring here $100,000 because you really had 150 of value of gain. You are recognizing 50, so you are going to eventually have to recognize 100 in the future. So what's the basis of property B? That's going to be the fair market value of property B minus the deferred gain plus deferred loss, but there's no deferred loss in this example. I would write out the formula with that every time though, because different examples have different situations. That's going to be $300,000 minus 100 to give you $200,000. So in this example, we see that the basis of property B is $200,000. The recognized gain of $50,000 is taxable, while the deferred gain is of $100,000 will affect the basis of the new property and will be recognized when property B is eventually sold in a taxable transaction. Not a bad example, classic example. Make sure you know something like this and you'll be prepared for the exam. See an example here, realized gain with no boot. Say you own an investment property, which is property A. It's got an adjusted basis of $200,000. You participate in a like-kind exchange and receive another investment property, which is property B. That's worth $250,000. What is the gain realized? So simply put, what did you give up versus what did you get? Looks like that is going to be $50,000. That's our realized gain. What really happened? We got a nice little kicker there. We got $50,000 of gain. And there's no boot received. So what's the lesser? Well, 0 is lesser than the realized. So here we're going to recognize 0. And then the basis in property B, that's going to be the fair market value of property B minus the deferred gain here, which gives us $200,000. Not too bad. Not too bad. But again, remembering that we want to take this from all perspectives, be able to do this for both parties, and understand the impact for everyone. Next up, we're going to see an example of a realized loss. Here we own an investment property, which is property A. It has an adjusted basis of $300,000. We participate in a like-kind exchange and receive another investment property, which is property B, but that's only worth $250,000. Uh-oh. Looks like we're getting something worth less than what we're giving up. The amount realized is the fair market value of property B. The adjusted basis of property A is $300,000. So what is the realized loss? What really happened? We really did lose value of $50,000 here. However, we know that losses are never recognized in a like-kind exchange, so the basis in property B is going to be the fair market value of property B plus the deferred loss. So our basis in the new property we got is $300,000, which is essentially just the basis of what we gave up, but that's another way of looking at it. Here, we've got another example. Here, boot received was greater than the gain realized. We own an investment property, which is property A, an adjusted basis of $200,000. You participate in a like-kind exchange and receive another investment property worth $220,000 plus $30,000 cash, which is the boot. The question's not going to give you on the exam. It's not going to say this is the boot, but this is the classic format of these questions, is that will be the boot. And just as a note, we saw a lot of intimidating slides with a lot of words on them, but now we're just seeing how these questions work. Yes, I'm sure you're not an expert right away. That will come with time. But you see how they're not as scary. They're not as intimidating. They're not as awful. You'll get through it. First, what is the amount realized? That's the fair market value of property B plus the cash received. So that's $250,000. The adjusted basis of property A was $200,000 as given in the question. The realized gain is the amount realized minus the adjusted basis of property given up. So that's $250,000 minus $200,000, giving us $50,000 of a realized gain. So we really gained through this $50,000. Sounds good. But what are we actually recognizing? We're recognizing the lesser of the realized gain or the boot received. So here, the boot received was $30,000, and that's the lesser of the realized gain or the boot. So that is $30,000 of recognized. So on our taxes, we're actually paying taxes on $30,000. What's our deferred gain? Well, it's basically just whatever gain was not recognized yet. That's going to go towards the future. And in this case, we're taking the fair market value of property B, deferring that gain, subtracting out the $20,000, so that when we eventually sell it for, let's say, $1 million, we have to pay tax on an extra $20,000 as compared to if the basis was a little bit higher. You got this. We're knocking these out, seeing every scenario, everything. We change one thing in a question. We add a higher boot than the realized gain. What happens if we eliminate boot? What happens? Be prepared for every scenario. All right, similar type question, but boot received was less than gain realized. And we're just running through as many examples as we can. We want to make sure that you are prepared as properly as you can be. You own an investment property A, an adjusted basis of $200,000. We've got a like-kind exchange, and we receive another investment property, which is worth $300,000 plus $20,000 of boot. The amount realized here, we really got $320,000. We really gave up $200,000. So here, the realized gain is $120,000. Awesome. Now, what is the recognized gain? That's the lesser of the 120 or the 20. So here again, we are going to see that we're using boot for our recognized gain. So we're recognizing 20,000. Deferred gain, realized gain minus recognized gain. That formula, absolute repetition. You can have these formulas down in a heartbeat. 120 minus 20 gives us 100. The basis in property B, we use the fair market value of property B minus the deferred gain plus any deferred losses if those were there. $300,000 minus 100 gives us $200,000. Next up, realized gain with boot paid. Because I think we've been receiving boot for the most of these. Now we're going to see what happens when we pay out boot. You own an investment property with an adjusted basis of $200,000. You participate in a like-kind exchange and receive another investment property, which is property B, worth $250,000 by paying $20,000 cash, which is the boot, in addition to property A. Now, don't get confused because saying here, you might just look at the question quickly and think that you're getting the cash because it's right next to the 250. Don't get tripped up. Make sure you read the questions carefully. So what's the gain realized? Well, the amount realized, we actually received $250,000 and we gave up $200,000. So the realized gain here is $50,000. Since boot is paid and not received, the recognized gain is $0 and the deferred gain is $50,000. Now, what is the basis in property B? This is where we finally take into account the boot paid. See, we're adding to our formulas. Look at that. When we have boot paid, we add to the formula for the basis in property B. This cash you're paying gets deferred and added to the basis of your new asset so that when you eventually sell it, you have a higher basis and thus pay less taxes. The fair market value of property B minus the deferred gain plus the boot paid gives us $220,000. Perfect. We're running through these and making good work of them. Next up, you own an investment property with an adjusted basis of $200,000. Now we got debt assumed and debt relieved. We did mention that in prior slides. Now we're going to see how it actually works. We have the property of $200,000 with a mortgage of $100,000. We have a like-kind exchange. We receive another property. This one's worth $300,000 with a mortgage of $80,000. All right, so we'll see how these debt pieces play a role, and we'll modify our formulas accordingly. Obviously, we've got some debt assumed and debt relieved. So the amount realized here, the fair market value of property B, minus the debt assumed plus the debt relieved, that's $300,000 minus the $80,000 of the debt that we have to now take into account, plus $100,000 because that's the debt we're getting rid of. That's $320,000 of value we're getting. We're giving up $200,000. So what really happened? Overall, we benefited $120,000. Since no boot is received, the recognized gain is 0 because 0 is less than 120, and the deferred gain is 120. The basis in property B is going to be the 300 minus the 120, and that gives us 180. Now you just see, this is what happens when we've use this formula. And if there's no debt assumed in the question, eliminate that portion. If there's no debt relieved in that question, eliminate this portion. That's all there is to it. Memorize the formulas. It's like Legos. Put the pieces in, take them out when you need. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.